Global markets wobbled again today. Tariff talk took center stage. I've got the quick rundown in under 3 minutes. Two forces pulled in opposite directions. Tough trade headlines, a friendlier Fed. First, tariffs. Former President Donald Trump said he has no plans to pause global tariffs, and reiterated he's ready to raise duties on China unless Beijing backs down on retaliatory levies. That kept risk appetite tight, especially early in Europe. This is on top of the broader backdrop. He already announced a 100% tariff on Chinese imports and new U.S. export controls on critical software. China, for its part, has leaned into other markets, pushing exports higher to Europe, Southeast Asia, and Africa even as shipments to the U.S. fell this year. Europe and the U.K. opened weak. London's FTSE 100 and major European indexes sold off early as investors priced in the tariff overhang. By the close, the FTSE 100 clawed back to finish flat to slightly higher healthcare materials, plus rate cues coming from the U.S. In the U.S., stocks shook off the tariff angst. The Dow jumped nearly 500 points, the S&P 500 nudged up near record highs, and the Nasdaq managed a small gain after early tech weakness faded. The big assist, the Federal Reserve's 25 basis point rate cut this week, and signals it's open to more easing if the data says so. So why the tug of war? Tariffs tighten financial conditions through higher costs, and uncertainty, while a rate cut loosens them by lowering borrowing costs and boosting risk appetite. Today, the Fed's move won the session, at least in the U.S. zoom out, and the macro picture is messy. Average U.S. tariff rates have spiked to levels not seen since the 1940s, and they ramped fast. Studies from the Fed and academic labs suggest tariffs are a drag on growth, roughly a half point off GDP in 2025 and 2026, while inflation pressures have been sticky since baseline tariffs kicked in earlier this year. On the ground, companies and consumers are eating much of the bill. Estimates say U.S. firms and households will shoulder most of the tariff costs, with consumers paying about half of the price increases. Big names have flagged billion-dollar headwinds tied to duties. No surprise consumer sentiment is near historic lows heading into the holidays. Globally, China's Premier Li Qiang says tariffs deal a severe blow to the world economy. Yet China's trade surplus has surged past $1 trillion, supported by exporters diversifying away from the U.S., rerouting supply chains and leaning into price-sensitive markets. Meanwhile, U.S. imports from China are down sharply as sourcing shifts to Indonesia, Vietnam, India, and the broader South Asia-Pacific region. Bottom line for today, markets were choppy, not universally weak. Europe felt the tariff sting early, then stabilized. U.S. benchmarks ended higher as central bank support outweighed trade fears for now. What I'm watching next, any hint of a tariff pause, or escalation especially on China, and even Mexico. How quickly the Fed's cut filters into earnings guidance, sector rotation. Does money keep moving from mega-cap tech into defensives like healthcare and materials? For investors, it's a barbell day. Respect the tariff volatility, but don't ignore the tailwind from easier policy. Risk is elevated, dispersion is real, and headlines are moving prices intraday. I'll keep tracking it. Follow for the next snapshot as the two forces, tariffs versus the Fed, keep battling it out.